All right, so are you ready to dive into a strategy that some investors totally swear by?
Okay, I'm listening.
We're talking about finding those golden opportunities right in the middle of a market crash.
Yeah, yeah,
And
yeah.
and specifically we're zeroing in on dividend stocks. You know, those steady earners that just keep paying out even when the rest of the market is going bonkers.
Right, right. Those reliable guys.
Exactly. And for this deep dive, our guide is going to be this awesome article called Dividend Stocks Thriving After the Last Market Crash.
It's funny. Most people, when they see a market crash, they just think disaster.
Right. Total panic.
Yeah, yeah. But for the long-term investor, it's kind of it's like Black Friday on Wall Street.
Ooh. I like where this is going, but okay, before we hit the bargain bin,
Yeah.
let's make sure everyone's on the same page what actually causes a market crash.
Right.
It's not just everybody waking up on the wrong side of the bed, right?
Definitely not, no. Although fear and panic do play a role, for sure.
For sure.
You see, crashes are usually triggered by a whole bunch of things happening at once.
Okay.
Economic bubbles bursting, unexpected global events.
Mm-hmm.
Sometimes even just a loss of confidence in the whole system.
Right, right.
Think back to 2020, the COVID crash.
Oh, yeah. That's definitely still fresh in a lot of people's minds. A global pandemic, not exactly what you want.
Exactly. It was
Yeah.
like the perfect storm of uncertainty.
Wow.
And yeah, naturally, investors just hit that panic button.
Yeah.
But here's the key takeaway. Those dips create buying opportunities for those who stayed cool,
Okay.
especially when it comes to dividend stocks.
All right, so for anyone new to the game, remind us what makes dividend stocks so special.
Okay.
I get that they pay out, but is that really all there is to it?
Well, on the surface, yeah, you are basically getting a share of the company's profits just
Right.
for owning the stock.
Right.
But think about it a little deeper. Those payouts usually come from companies with a proven track record, of stability and profitability.
Okay.
They're not just some fly-by-night operation.
So they're like the reliable friend that always chips in for gas on a road trip,
Yes, exactly.
even when things get bumpy.
That's a great analogy.
And during a downturn when everyone else is stressing about the price swings, that reliable income stream from those dividends
Right.
must feel like a life raft almost.
Yeah, it can be a really powerful psychological tool to help you just stay the course.
Stay calm.
Yes, exactly.
All right, so let's get specific. Our article focuses on the COVID crash, and it highlights 10 dividend stocks that performed exceptionally well.
Yes.
Just to be clear, though, we're not saying this is financial advice, right?
Oh, of course not.
Yeah.
This is about understanding what happened back then,
Yeah.
not giving specific recommendations.
Gotcha.
Past performance. It's never a guarantee of future results.
Right, of course. But it's still a fascinating case study.
Oh, for sure.
So let's rewind back to March 2020, when it felt like the world was turning upside down. Our first company on the list is Johnson & Johnson, a household name for sure. What were things looking like for them back then?
Well, even a giant like J&J wasn't immune to the crash.
Right.
Their stock price dipped to around $109 a share.
Wow.
Keep in mind, this is a company with a massive portfolio, pharmaceuticals, consumer health products, medical devices.
Yeah.
They're not a one-trick pony.
So even with all that diversity, they still took a hit.
They did.
But I'm guessing they bounced back.
Oh, absolutely. By 2024, their stock price was sitting at around $155.
Okay.
That's over a 40% increase,
Wow.
not even factoring in the dividends they were paying out the whole time.
Hold on, I need to do the math here. So if someone had invested $1,000 in J&J at its lowest point in March 2020.
Well, they'd be looking at a gain of over $400 plus whatever dividend income they received.
Nice. And speaking of dividends, J&J is what's known as a dividend king.
Yes.
A dividend king sounds impressive. What does that even mean?
It means they've increased their dividend payments for over 50 consecutive years.
Wow.
That kind of consistency is a huge signal to investors, especially during a market crash. It's a sign of strength and commitment to shareholder value.
So J&J shows us that diversification and a strong track record can really pay off.
Definitely.
Now, next on our list is another consumer giant, Procter & Gamble. I bet their products flew off the shelves during lockdowns.
You're not wrong. People still needed their Tide detergent and their Pampers diapers,
Right.
no matter what was happening in the stock market.
Toilet paper.
Exactly. P&G stock dipped to around $94 during the crash.
Given their product line, I'd imagine they fared pretty well in the long run. How did their stock actually perform?
They recovered remarkably. By 2024, their stock was trading at about $160.
Okay.
That's nearly a 70% jump.
Wow. So even in a crisis, people stick with the brands they trust. That's a powerful lesson for investors, too.
Exactly. Recognizing those essential companies can be a key part of weathering any storm.
All right, let's get this momentum going. Next up is a classic Coca-Cola. I can't imagine a world without Coke, but I bet even their stock took a hit.
Oh, it did. In March 2020, Coke's stock price fizzled down to about $38 a share. Restaurant closures and event cancellations definitely put a dent in their sales. You know,
Yeah.
makes sense. But people were still buying Coke at the grocery store, right?
You're right, of course.
Did that help them recover?
I would hope so.
It certainly did. Like a well-shaken bottle, their stock popped back up to around $60 by 2024.
Okay.
That's over a 50% increase. Not too shabby for a company a lot of people thought would really struggle during the pandemic.
Yeah, it's a good reminder that even when a company's short-term prospects look a little shaky, their long-term brand power can still prevail.
Absolutely. And let's not forget the dividends. Coca-Cola, like Johnson & Johnson, is a dividend king, meaning they've consistently increased their payouts for decades.
Okay, so we've got these giants like J&J, P&G, and Coca-Cola all showing amazing resilience during the crash.
Yeah.
Is there a common thread here, like something investors should be paying attention to?
One thing that really stands out is their focus on consumer staples. Things people need no matter what the economy is doing. Whether it's medicine, cleaning supplies, or that afternoon caffeine. These companies provide products that are deeply ingrained in our daily lives.
Makes sense. People might cut back on vacations or fancy dinners during a downturn, but they're not going to stop brushing their teeth or doing laundry.
Exactly. That's why understanding a company's core business and its place in the market is so crucial for investors.
Okay, so let's see if this trend holds up with our next company, PepsiCo. They're not just about sugary drinks anymore, right?
Not at all.
Oh.
PepsiCo has cleverly diversified their portfolio to include a wide range of snack brands like Lay's potato chips and Quaker Oats.
Oh, yeah.
That gives them a broader reach across consumer spending habits.
So even if people were drinking less soda during the pandemic, they were probably snacking more at home. Did that strategy pay off for PepsiCo's investors?
Big time. Their stock dipped to around $101 during the crash, but rebounded to a whopping $175 by 2024.
Okay, that's another impressive gain. It seems like this consumer staples theory is holding strong, but let's shake things up a bit. What about a company that's not selling products people consume, but rather a place for businesses to operate?
You're talking about Realty Income, the real estate investment trust that's famous for paying dividends. Get this, monthly.
Monthly dividends now, that's intriguing. But how did a company reliant on rental income fare during a time when businesses were shutting down left and right?
There were definitely concerns, and Realty Income stock did take a hit, falling to around $38. But their diversified portfolio of properties, many leased to essential businesses, helped cushion the blow.
So they weren't just reliant on fancy boutiques or high-end restaurants that might struggle during a lockdown.
Exactly. They had a mix of grocery stores, pharmacies, and even some government buildings in their portfolio, all providing a more stable income stream. By 2024, their stock had climbed to $55, proving that even in real estate, diversification can be key to weathering a storm.
And that monthly dividend payout probably felt like a welcome lifeline for investors during those uncertain times. Speaking of lifelines, our next company is in the business of providing actual medical lifelines. AbbVie, the pharmaceutical giant behind the blockbuster drug Humira.
AbbVie is an interesting case study because they faced a unique challenge during the pandemic. Humira's patent was expiring.
Oh, wow. So they had the market crash and a major product losing its exclusivity all at the same time. That must have been a tough situation.
It was their stock took a hit, falling to around $65 in March 2020. But AbbVie had been preparing for this moment. They had a pipeline of new drugs ready to take Humira's place, and they were able to reassure investors that their long-term growth strategy was still intact.
So it wasn't just about weathering the storm, it was about having a plan for what came after the storm.
Precisely. And their stock performance reflects that foresight. By 2024, AbbVie's stock had skyrocketed to around $155, showing that investors who look beyond the immediate challenges were richly rewarded.
Okay, so far we've seen companies thriving in consumer staples, real estate, and pharmaceuticals. Now, let's shift gears to a sector that was hit hard by lockdowns and social distancing restaurants. What happened to the king of burgers, McDonald's?
Even McDonald's wasn't immune to the initial shock. Their stock dropped to about $148 as people stayed home and dining rooms sat empty. But then they did what McDonald's does best. They adapted.
Yeah, I remember those endless lines at the drive-thru back then. It seemed like everyone was craving comfort food during those stressful times.
Exactly. McDonald's doubled down on their drive-thru and delivery operations, and it paid off big time. Their stock rebounded to a sizzling $280 by 2024.
So even in a sector that was seemingly devastated by the pandemic, there were still winners for those who knew where to look. It's about finding those companies that can pivot and adjust to the new reality.
Absolutely. And that brings us to another company that was perfectly positioned to capitalize on the changing consumer landscape, Home Depot.
Ah, the DIY haven. Everyone was stuck at home staring at their walls and suddenly feeling the urge to renovate.
It was the perfect storm for Home Depot. Their stock dipped initially, falling to around $140 as the market crashed. But then as people turned to home improvement projects to fill their time and improve their living spaces, Home Depot's stock went on a tear.
I bet those earnings calls were pretty exciting back then. Did they manage to keep that momentum going?
They did. By 2024, their stock was trading at a remarkable $340, showing that understanding consumer trends and being adaptable can be a recipe for success even during a crisis.
Okay, we've covered a lot of ground here, from consumer staples to real estate pharmaceuticals to fast food and home improvement. We've seen companies across various sectors not just surviving, but thriving after the COVID crash. But now let's step into the world of tech, a sector that's always been a bit of a wild card. First up, the behemoth itself, Apple.
Now, Apple isn't typically known for its high dividend payouts. Their focus has always been on growth and innovation. But even they felt the tremors of the crash. Their stock, adjusted for their stock split, dipped to around $56 in March 2020.
But I bet people were still buying iPhones and Macs like crazy, right? Did that help them bounce back?
Oh, absolutely. Apple's brand loyalty is legendary, and their product ecosystem is so deeply embedded in people's lives that even a pandemic couldn't derail their momentum by 2024. Their stock had climbed to an astronomical $180, proving that sometimes betting on the giants can pay off big time.
It's amazing to think that even during a global crisis, people's desire for the latest gadgets didn't diminish. Now, our final company on the list is another tech titan, Microsoft. They're not just about Windows anymore, are they?
Yeah, not at all. Microsoft has become a cloud computing powerhouse with Azure, and their gaming division with Xbox has also been a major growth driver. This diversified portfolio helped them weather the storm and emerge stronger than ever.
Okay, I'm sensing a theme here. Diversification seems to be the key ingredient for success no matter what sector we're talking about. So what happened to Microsoft's stock during all this?
Their stock took a hit, falling to around $135 during the initial crash, but their cloud business boomed as remote work became the norm, and their gaming division saw increased demand as people sought entertainment at home.
So they were kind of accidentally prepared for a pandemic world.
You could say that, and their investors certainly benefited from that preparedness by 2024. Microsoft stock had reached an impressive $400, showing that even in the ever-evolving world of tech, those who can adapt and innovate can come out on top.
Okay, we've journeyed through 10 companies across diverse sectors, all showing resilience and growth after the COVID crash. It's clear that dividend stocks, especially those from companies with strong fundamentals and a knack for adaptation, can offer a sense of stability and potential for long-term returns. But it's not just about picking the right companies, right? Our source also highlighted some key lessons learned from the COVID crash, things that apply to, any investor, really.
Well, for sure. The first one, and this can't be overstated, is that patience pays off big time.
Yeah.
Investors who panicked and sold at the bottom, they totally missed out on that huge rebound that followed.
It's that classic saying, right time in the market beats timing the market.
Exactly.
It's so tempting to try and predict those ups and downs, but it rarely works out.
Yeah, exactly. Consistent investing over the long term is the most reliable strategy, especially when you pair it with dividend stocks. Those payouts can provide a real sense of stability, when everything else feels chaotic.
It's like having that steady paycheck coming in, even when the market is throwing a tantrum. Speaking of those payouts, can we dive a bit deeper into dividend yields? Our source mentions them, but I think it would be helpful to really understand how they work and why they fluctuate.
Sure. Let's break it down. A dividend yield is essentially the annual dividend payment per share expressed as a percentage of the stock's current price.
Okay.
So if a company pays out $2 in dividends per share each year and the stock price is $50, the dividend yield would be 4%.
Okay, that makes sense. But why do those yields change over time?
Well, the dividend payment itself might change. Companies can increase or decrease their dividends depending on, their earnings, their financial strategy. And then there's the stock price, which is always in flux based on market conditions and investor sentiment.
So even if a company maintains a steady dividend payment, that yield can still fluctuate based on how the stock price is performing. That makes it even more important to understand a company's overall financial health and not just chase those high yields.
Exactly. A high yield might seem tempting, but it could be a sign of a company that's struggling and trying to attract investors with big payouts.
So it's all about context. Another key lesson from our source is the importance of buying quality companies that might seem obvious, but what exactly does that mean in practice?
It's about looking beyond the hype and buzzwords. Examine a company's financials, their earnings, their debt levels, their cash flow. Look at their management team. Are they experienced? Are they trustworthy? And consider their competitive advantage. What sets them apart in the market?
It's like doing a background check before entering into a serious relationship. You want to make sure they're the real deal and not just putting on a show.
That's a great analogy. And finally, let's revisit the idea of diversification. We've seen how companies with a broad range of products and services were better able to withstand the COVID crash. But diversification goes beyond individual companies.
Okay, I'm intrigued. What else should we be diversifying?
Think about different sectors. We've seen how consumer staples, healthcare, and even tech, despite the initial volatility, can offer resilience during a downturn. Don't put all your eggs in one basket.
So spreading your investments across different sectors can help mitigate risk. What about different geographic regions? Should we be looking beyond the U.S. market?
Absolutely. Emerging markets, developed economies, there's a whole world of dividend-paying companies out there. International diversification can be another layer of protection against market shocks.
So it's not just about what you're investing in, but also where those companies operate that adds a whole new dimension to portfolio construction.
Exactly. And remember, this deep dive focused specifically on the COVID crash. But these lessons, patience, quality diversification, they're timeless principles of investing that apply to any market environment.
It's about building a portfolio that can weather any storm, whether it's a pandemic, a recession, or some unexpected geopolitical event, and knowing that even in the darkest of times, there are companies out there paying out dividends, quietly generating value for their shareholders.
It's a reminder that the market is a powerful force, but with knowledge, patience, and a well-thought-out strategy, you can harness that power to build long-term wealth.
That's a great note to end on. Thank you so much for sharing your insights with us today. And for our listeners, if this deep dive has sparked your curiosity about dividend investing, remember, do your research, consult with a financial advisor if needed, and most importantly, stay informed and stay engaged. Thanks for joining us on the deep dive.